All right, let's jump right into this explainer. Today, we're putting on our most skeptical, investigative equity research hats. We are completely stripping away the Wall Street hype and digging deep into the actual financial filings of Roivant Sciences, ticker symbol ROIV. We're going to put this stock through the ultimate valuation gauntlet to figure out what is actually going on beneath the surface.
But first, we have to lay down the mandatory legal framework. Disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
Okay. Now that that's out of the way, let's look at this massive, glaring contradiction that immediately caught my eye when I was digging through their numbers. If you just glance at the recent headlines, Roivant missed their earnings per share target by a whopping 25%. And if you flip open their 10K, full-year revenues literally dropped by nearly 71%. Now, in a normal market for a normal, mature company, those kinds of numbers would trigger an absolute massive sell-off. But Roivant's stock has been hovering right near its 52-week high of over $41 a share, and it's delivered triple-digit returns over the past year. Honestly, how is that even possible? Well, to understand why, we have to crack open the ledger.
So let's start with Section 1, the earnings illusion, looking under the hood of Q1 2026. To figure out why the stock is up, we really have to look at the sheer brutality of their income statement. When we pull the Morningstar data and the latest SEC filings, it paints a very grim picture if you're using traditional metrics. Look at this. Fiscal year 2026 revenue was just $8.26 million. That is down over 71% year over year. Operating income, a staggering negative $1.28 billion, fueled heavily by climbing R&D expenses that hit over $681 million. Q1 of 2026 really didn't look much better on the top line either, just $1.44 million in revenue and a net loss approaching $190 million for a single quarter.
And that brings us to the headline number that retail investors so often panic over. Roivant posted a Q1 EPS of negative 75 cents. Wall Street analysts had forecast negative 60 cents. That is a solid 15-cent miss. Like I said, for a mature, cash-flowing business, missing earnings by 25% is usually devastating. But for a pre-profit, development-stage biotech company like Roivant, the size of the miss on the income statement is actually way less important than the direction of their spending. They aren't accidentally losing money. They are intentionally burning cash to build something massive.
Which transitions us perfectly to Section 2, the balance sheet fortress, while the stock is surviving.
So, you're probably wondering, why isn't the stock collapsing under all that loss? To answer that, we have to look past the income statement and examine the balance sheet. And this number right here, this is the shield protecting Roivant shareholders, $3.9 billion. As of June 30th, 2026, Roivant reported consolidated cash, cash equivalents, and marketable securities totaling $3.9 billion. This is a massive, massive buffer. In the biotech sector, cash is quite literally oxygen. It dictates your runway, it dictates your ability to fund expensive clinical trials, and perhaps most importantly, it protects early investors from being diluted by secondary stock offerings. But wait, it actually gets better. That $3.9 billion figure, it doesn't even include the massive windfall that just landed in July. And guys, this brilliantly illustrates why reading the footnotes in these filings is absolutely crucial. I was totally amazed when I dug into this part of the 10K. Roivant subsidiaries reached a $2.25 billion global settlement with Moderna over lipid nanoparticle technology. Roivant received an upfront cash payment of $950 million right after the quarter closed. Plus, there's another $1.3 billion sitting on the table contingent on a favorable appeal. Oh, and they filed new international lawsuits across 21 jurisdictions against Pfizer and BioNTech. This is massive, non-dilutive capital flowing directly into the business without costing shareholders a dime.
So the crucial point here is understanding what you are actually paying for when you buy the stock. Let's do a quick valuation reality check. Based on Morningstar data, the book value per share, which is just the intrinsic accounting value of all their assets minus their liabilities, is $5.86. But the stock is trading around $38.79. That is an enormous premium. Basically, the market is pricing in nearly $33 a share of pure expectation. So what exactly are they expecting?
That brings us to Section 3, the catalyst pipeline, what the R&D spend is actually buying, or in finance terms, real options.
So, what is Wall Street expecting? Well, as an analyst, we have to view their massive R&D cash burn as buying what we call real options, meaning they are buying future clinical readouts that could potentially become blockbuster drugs. CEO Matt Glein actually called this past quarter the calm before the storm, and you can see why. Just look at this catalyst density on the timeline. Over the next 2 years, we aren't just waiting on one single drug to hit, we are waiting on a massive wave of Phase 2 and 3 data readouts for rare autoimmune and pulmonary diseases. We're talking about huge milestones hitting one after another through 2027 and 2028. The market is happily paying a premium today for the high probability chance that one or more of these binary events hits big and completely reshapes the medical landscape.
Moving right along to Section 4, the media blackout flags. 7 red versus 7 green flags buried in the filings.
Let's step away from the flashy headline catalyst for a second and look at the proprietary flags the financial media totally ignores, usually because they're just too complex for a 10-second soundbite. On the red side, it is all about clinical and execution risk. For instance, management themselves called out variable placebo response risks and translational trial risks in the footnotes, basically asking the question, will the early trial data actually translate into successful, FDA-approved therapies? There's also the risk of an unproven commercial launch, heavy general and administrative costs, and negative free cash flow conversion. Combine that with the 71% revenue drop and the $1.28 billion operating loss we talked about, and yeah, it looks a bit scary. But you got to look at the green flags on the right acting as a fortress wall. They have that $3.9 billion cash runway, heavily reinforced by that $950 million settlement influx. And perhaps most importantly, management has been aggressively buying back $200 million of their own stock, which signals they internally believe it's undervalued. Plus, they already have a fully built commercial team ready to go and a proven track record of monetizing their non-core assets. It's a fascinating tug-of-war.
All right, let's hit Section 5, the legendary investor reality check. Would the greats buy RIV today? So we have terrible current fundamentals mixed with incredible cash reserves and high-potential future catalysts. How would the absolute legends of investing process this? Let's put Roivant through the ultimate reality check. If we apply the strict quantitative methodologies of Ben Graham, Peter Lynch, and Warren Buffett to Roivant today, the stock fails every single one. Ben Graham, the father of value investing, he requires positive earnings to even calculate a Graham number, and Roivant's price-to-book ratio is nearing 6.6 times, way above Graham's strict 1.5 times limit. Peter Lynch's growth at a reasonable price model completely breaks down because, well, without current earnings, you literally can't calculate a PEG ratio. And Warren Buffett? He looks for consistent positive returns on invested capital and tangible owner's earnings. With massive R&D cash burn, Roivant generates negative owner's earnings today. Based strictly on trailing fundamentals, the legends would take a hard pass. So, here is our ultimate synthesis. From a purely traditional, quantitative standpoint, based on the average of historic value models, Roivant is statistically overvalued right now. Period. When we look at their economic moat, we'd have to categorize it as narrow to none currently. The moat relies entirely on intangible assets, future patents, and FDA approvals. But because clinical trial failure rates in biotech are historically so high, this type of moat is incredibly volatile. But, and this is absolutely the crucial distinction, traditional models are honestly the wrong tool for this specific job. The reality is that if you buy Roivant today, you are not buying a mature, cash-flowing widget manufacturer. You are buying equity in an incredibly well-funded $3.9 billion incubator. You are buying a suite of high-risk, high-reward clinical real options, managed by a team that has already proven they can successfully monetize assets and secure massive, non-dilutive capital through aggressive litigation.
So we are left with a really fascinating setup here. The traditional income statement and historical value models are screaming one thing, but the fortress balance sheet, the aggressive share buybacks, and a dense storm of upcoming clinical catalysts suggest something entirely different. The data is all right there in the filings. Which side are you on? As always, do your own homework. Thanks for joining me on this deep dive explainer, and I'll see you on the next one.